Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focused on clients who recognize the need for solid investment advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, March 17th, 2025 edition. Let's get started. All right, we start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. Stocks will go up and down on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. There's no way around it. The last 2 weeks were pretty crummy. We had a decline of about 5.3%, which brings our year-to-date gain to a negative 4.13%. We hit the all-time high on February 19th, and then between February 19th and March 13th, the stock market declined just over 10%, which Bloomberg News reports is the second fastest 10% decline from an all-time high ever. Fortunately, we did end the week with a 2% gain on Friday, so the damage wasn't as bad as initially looked, but still not an enjoyable 2-week period for the market. Next, we look at interest rates as measured by bonds issued through the U.S. Treasury Department. We believe that interest rates are the preeminent measure of investment risk. Rates are factored into every investment calculation, including stock valuations. And generally speaking, lower interest rates will lead to higher stock prices, and higher interest rates lead to lower stock prices. Rates, again, will move up and down on a daily basis. Our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Generally speaking, last 2 weeks we saw a slight increase in interest rates, mostly here on the long-term or medium-term and long-term end. So the interest rate listed over here on the left-hand side, the maturity length listed here along the bottom from 1 month, 3 month, all the way out to 10 years and 30 years. The green line is where we finished here March 14th. So each dot represents an interest rate for a given maturity length. And this brown line is where we were 2 weeks ago. Now, we mentioned 2 weeks ago that we had gone back into an inverted yield curve where the 3-month U.S. Treasury was higher than the 10-year U.S. Treasury. And over the last 2 weeks, that has corrected. So now we've got about a 4.31% rate on the 10-year, and our 3-month is at about 4.29, right? So barely not inverted by that measurement. However, we are maintaining our position that the Federal Reserve will cut the Fed funds short-term rate by a full 1% between now and the end of the year, which we believe will lead the short-term rates lower and give us a nice normal interest rate yield curve that suggests a healthy economy. Okay, now we get into our expectations and implications portion, and there's just still a lot to talk about, a lot that's happening, and we want to try to contextualize as much of it as possible so that it makes sense and that we can clearly articulate our position of where we think we are, where we think we're going. So the first thing we want to do is pull up this chart of the stock market. This is a 7-year chart of the S&P 500. The white line that's going up and down on a daily basis is the value of the market over the last 7 years, right? From March of 2018 through yesterday. And we've tried to identify some of the declines that we have seen over the last 7 years. So we've said this before, it's a good time to reiterate that over a 12-month period, we generally will see the stock market decline 5%. And that's normal, healthy stock market behavior. Once a year, once a 12-month period, we will see a decline of about 10%. And we can generally attribute that to some changes in the economy or some perceived changes that give us a little bit more concern about what might happen in the future. And then once every 3 years, we'll see a decline of 20% or more. And so this is the last 7 years to try to, again, contextualize where we are now versus where we've been. We had about a 20% drop in 2018. We had a more than 20% drop when COVID hit in 2020. We had a couple 5% plus drops Again, over time, we've identified some of those. The last time we had a 20% drop was in 2022, which was a tough year, right? The Federal Reserve was trying to battle runaway inflation. They were raising interest rates aggressively, and that ended up to an adjustment in our stock market of about 25%. Since we got to the bottom of that ordeal, we've pretty much been on an upward trend. And we did see a pullback in 2023 of 10%, a couple of 5+% declines. Again, haven't identified all of them, but now we're again at about a 10% decline from the all-time high. So first thing I want to point out is that this appears to be in line with normal market behavior. And yes, there's always headlines, there's always a lot of fear, and there's a lot of anxiety that come along with these types of events. But if I was, aside from the COVID pandemic and the inflation and interest rates that I think we're all still familiar with from 2022, if I was to ask about 2018 or 2023, does anybody remember why we had these pullbacks? Like, what were the headlines coming on at that time, leading to the market to decline? And I don't know how many people would remember, right? So I think when you're in the moment, it is definitely hard to endure. But I think after a while, we get out of these events and we don't really remember, right? I mean, I think this is one that we could probably remember, or at least I would think that we could remember. But every time we get in one, I feel like we're going to remember it. So and maybe that's just because it's my job. But again, we'll just leave it at that and say, look, we're in a time that's very normal, natural, on average with what we see in the stock market over history. Now, this green line is what we call the 200-day moving average. So 200 days in the investing world is about a year. When we take out weekends and holidays, we're left with about 200 days, 200 trading days in a year. And so we're looking at what is the average price for the stock market over a 200-day period. And that shows us what trend the market is going in. So generally speaking, like we see an upward trend. And then when we have a significantly down year like 2022, we see the downward trend take shape. So something that we get concerned about or that catches our attention is when the stock market falls below that 200-day moving average. So you can see back in 2018, we fall below, we kind of bounce around, and then we fall lower. So if we don't end up going back above the 200-day moving average and decisively stay above, that gets us a little bit concerned that maybe the market's not going to be able to maintain the upward trend, but it's going to have a more significant pullback. Again, in 2020, I think there were a lot of external measures taken with monetary and fiscal policy, a lot of bailouts and efforts to try and sustain the economy in light of the COVID pandemic and the shutdown that occurred. And that helped us get back above that 200-day moving average relatively quickly, all things considered. 2022, we crossed below it, and we spent a lot of time on this in 2022, but we crossed below it, we come back above, we cross back below, and then we stay below for a long time. Even in August, we get right back to it and then pull back again, which again suggested to us or confirmed that we were maintaining the downward trend. And it wasn't until 2023 that we finally got back above that 200-day moving average and moved onward and upward. But from the all-time high that we hit here at the end of 2021, beginning of 2022, it was a good, almost 2 years before we had all-time highs again. We have up days, right? We have up weeks, up months, even if we're in a downward trend. But over time, this is one metric that we use to try to figure out where we are and where we're going. Here in 2023, again, we don't remember what this was, what the news was that led to the decline of 10%, but we dropped down below that 200-day moving average and we're quickly above for, only below it briefly, and then we quickly recover. And it's really been, smooth sailing for the last 12, 14 months. Even though we've had some pullbacks, right? We have down days, we have down weeks, down months, even if we're in an uptrend like this. So now we have broken below that 200-day moving average. And we're asking ourselves, is this going to be like a 2018? Or is this going to be like a 2022 or a 2023? And there's no way to know for sure, but what we're expecting is we're at least going to get back up to this 200-day moving average, right? 5740 is where the 200-day moving average is as of Friday. From where we closed, that's an increase of 1.8%. And we might go above it. We might kind of bounce around a little bit. If we bounce around, that gets us a little bit more concerned that we're going to drop back below, and that this could turn into a 20% decline. And there's a lot going on over the next couple weeks that would lead to that, right? The Federal Reserve has their meeting for March on Wednesday, the 19th. Whatever is said about the economy and about the interest rate forecast could push us either direction. We still have a lot of economic data that comes out on a daily and weekly basis. But President Trump has also picked April 2nd as the day that we're going to start doing reciprocal tariffs, right? Regardless of what additional tariffs we're threatening and implementing and rescinding. Reciprocal tariffs are supposed to start on April 2nd. And I think that's kind of like his big day of this is when everything's going to be implemented, either we're making a deal or this is what's going to happen as of April 2nd. So that would lead us to believe that maybe we would continue a decline if things continue or get implemented on that day as described. So hopefully that makes sense, at least for the short term, right? For the next 2 weeks, we are expecting the stock market to at least get back up to that 200-day moving average. We'll kind of wait. We'll see what the behavior is, and that might be an opportunity for us to look for more rebalancing. And if this is the case, we would probably be adding some cash or setting aside some cash on a rebalance, assuming that things take a leg lower so that we've got some cash available to then invest if we do end up going down to that 20%. We are okay if the market decides to march higher and sustain that upward trend, then we're okay having a little bit of extra cash and not feeling the full weight of that that rise in the market because history tells us that there's enough evidence we believe that this could be the next 20% drop that we want to hold on to some cash. We're hopeful that things don't go that way, that the Federal Reserve says the economy is fine, that they're going to plan to reduce interest rates and the market charges higher, that Trump figures out some deals on tariffs that make it better than we think, that these wars in Russia and Ukraine and Israel come to an end and we can start rebuilding efforts. Like there's a scenario that we can absolutely see that this just takes off from here. But again, we're going to be a little bit more on the conservative side. And when we get back up to that 200-day moving average, we'll look at doing some more rebalancing and adding cash in the event that we are not able to get our best case scenario. Okay, now I'm going to put on my professor hat and try to provide some education to those that want to be educated through the process. So what we've got here is what we call the discounted cash flow formula. And whether you're a CFO looking to invest in a project for future sales and earnings growth, or you are a chartered financial analyst looking to invest in a stock, or a real estate investor looking to invest in a property, every calculation that we do really is derived from this model, right? This is like the foundational formula that everybody uses or tweaks to get their own calculation for a valuation. All right, so on the top, we've got cash flows. We got future expected cash flows from whatever the investment or project is. On the bottom, we've got our interest rate. And so we're taking those future cash flows, we're discounting those by an interest rate, and that gives us a valuation. And if it's a positive valuation, if it's something that we think looks good or is sufficient to cover their costs and provide us with the growth that we're looking for, then we will invest. If it doesn't, then we don't invest, so on and so forth. So the reason I pull this up is because, again, when we talk about stock prices going up and down on a daily basis, interest rates going up and down on a daily basis, and what is the impact on valuation for our investments. Uh, the last 2 years of President Biden's term, I feel like we had a pretty good idea about what the Federal Reserve was going to do with interest rates. And it wasn't until we got some, uh, we'll say, uncertain information, or the certainty was contrary to what we thought it was going to be, that we then adjust our position, right? So when we say lower interest rates lead to higher stock prices and higher interest rates lead to lower stock prices, if our expected cash flows remain the same and this interest rate goes up, that calculation is going to lead to a lower discounted cash flow. So if we think that the Federal Reserve is going to lower interest rates and they end up not lowering interest rates, or they raise interest rates, then this calculation on the denominator is going to drive that overall valuation calculation lower. But if the interest rates end up coming down faster than we think, then that should boost stock prices, which we've seen in the past as well. But what we have been witnessing over the past 2 months with the new administration, and tariffs being implemented, and then, or threatened and implemented and rescinded, sometimes all within the same day. We've seen a lot of uncertainty with the wars getting ceasefire deals that get rescinded, and then we're coming back to the negotiating table, and then we had the threat of a government shutdown, which throws another element into the whole calculation. But we think a lot of what we saw Friday was the result of Congress coming to an agreement and not leading to a government shutdown, and seeing a little bit of a relief rally because of that. But when we're doing calculations on these expected future cash flows and these expected interest rates, the more certainty we have, right? We're using statistics to try and forecast these things. So the more certainty we have, more confidence we have of an outcome, the more likely we're going to achieve it, the more stable the stock market is going to be. When we start introducing a lot of uncertainty, right? Whether it's tariffs, whether it's wars, you can name a whole bunch of different factors. We're now widening the range of outcomes, which just makes it so much more difficult for us to come to a valuation that we think is an accurate representation of where we are today. And we think that in part we've seen a decline as fast as it's been because we've had people say, you know what, just forget it. Like, we're just going to sell, we're going to go to cash, and we're going to wait until either we get clarity on all this tariff policy, or we get better clarity on interest rates, or all the above, or we get clarity on these wars. And so uh, it it's a challenge. It's significantly difficult to do this. And these things, this is a simple formula, simple calculation, but again, this is kind of the starting point. So, you know, they're usually more complex. And I don't personally have artificial intelligence I'm using to do these calculations. I assume there are larger institutions doing it, but it's still a laborious process. So if you're putting in a lot of effort into a calculation, and then by the end of the day, your variables have completely changed, right? Like, it becomes an opportunity for people to take a step back and say, you know what, we're just gonna we're gonna hold off. We're not gonna do this until we feel like we can get our statistical confidence levels back into a range that we're comfortable with. All right, we get into the final word portion. Hopefully this hasn't been super long. Hopefully this makes sense. If it doesn't make sense, please reach out and ask any questions that you need clarifying on. But um, we're just trying to express where we think we are, where we think we're going, why it's so difficult for us to know exactly where we think we're going to end up. But we're confident that should we get past all of this tariff stuff, should Elon Musk finish all of his government efficiency stuff and go back to work at Tesla, that we could get to a point where we're no longer focused on the potentially destructive or harmful policies of tariffs and reducing government, um, and focus more on economically stimulative items like tax reform and whatever else we can come up with. But anyway, so I was able to have my son, my seventh grader, come to my office. It was a job shadow day on Wednesday. And we spent a lot of time trying to teach him everything that I know. Again, trying to water it down so that it all made sense to a seventh grader. We spent some time looking at companies that he's familiar with. It was impressive to me to know how many companies he was familiar with. He'd say a name and we'd look it up, and a lot of them are publicly traded companies. And here's some of the things that we look for and we try to identify when we decide if we're going to invest or not. And anyway, I told him, I'm like, hey, we'll pull up my retirement account and whatever you want to buy, whatever you want to invest in, we'll do it. Of course, making sure it's one that I'm okay with, not just some random company. But by the end of the day, we had purchased one share of Meta Platforms, the parent company of Facebook, and also one share of Tesla. Um, he then pulled up his stocks app on his phone and plugged those in and has been tracking them religiously ever since. Thursday was a down day, and Friday was an up day for the market and for those companies. And on Thursday, he was commiserating. Why did I do this? Why did I tell you to invest in these? You should just sell them. And then on Friday, he was like, "Oh, just kidding. I'm glad you didn't listen to me." And I said, "Look, a lot of it has to do with our time horizon, right? Like I'm not planning to retire anytime soon. These are stocks that have kind of been beat up over the past month, and I'm fine holding on to these for a long period of time. And so what happens from one day to the next doesn't necessarily affect me." And he's also very young, and we're hopefully gonna have him around and investing before you know it. And don't want him to feel like if it doesn't work every single day, or if it's not positive all the time, that doesn't mean you have to sell it. It just means there's reasons why it's going up and going down. But I think as a final word for all of my clients, it's kind of the same thing. Like if you watch the market and you're tuned into the news, it can be very depressing, um, to say the least, and concerning, like a lot of anxiety. And the more you pay attention to it, the more you're going to feel like we should just sell and get out because it's all going to be a horrible ending. But again, over time, we see that things work themselves out and the market continues to rise. And we want to see these as buying opportunities and not opportunities to panic and sell. So I guess the last analogy that I wanted to use is if we are trying to if we're playing a baseball game and I'm playing third base, somebody hits a baseball to me and I'm trying to throw the ball to the first baseman. That first baseman is static, and I just have to throw it on target and he'll catch it. We'll get the person out. But if I am a quarterback in football and I'm trying to lead my receiver to catch a ball and hopefully score a touchdown, then where I'm throwing that football is in a different place than where the receiver is when that ball leaves my hand. So we're trying to we're trying to match it up, right? We're trying to get our future expectations of where we want to be matching up with where the market is and where we think the market's going to be, and hopefully they sync up. And so yes, right now is a challenging time, and it could potentially get even more challenging, as we wait and see how the next couple weeks play out. But we're looking 6 months down the road, 12 months down the road, and we're believing that this is not going to be an extended downturn in the market, but that we're going to be able to recover and get back to all-time highs. And this is more of a buying opportunity for us to reposition for. So again, thanks for all your patience, but as always, if you have questions regarding your specific investments and accounts, please reach out and let us know. Otherwise, have a good week, and we'll see what happens.